Hello, I'm Lee. I recently did a video on trade management of a strangle, and I got a few comments back, and some people have asked me to spend a little bit more time talking about what do I mean by having neutral deltas on my strangle, or why do I want to manage the trade for neutral deltas? What does it mean to have a neutral strangle? So I decided I'm going to do a new video on how to manage a strangle. This time I'm going to use a Facebook strangle that we did, and I'm going to put a special emphasis on what it means to have neutral deltas. So let's take a look. Let's start off by talking a little bit more about a review about what a short strangle is, and that is selling a put for a credit and selling a call for a credit. And I know this is review for most of you. It'll be really quick. This is a neutral strategy, and we're expecting the underlying stock, in this case Facebook, to stay within a defined range. And that defined range is my short put and my short call. Okay, now the way I pick those strike prices is by looking at a probability distribution curve. I expect it to stay in a certain range, and that range is basically plus or minus 1 sigma or 1 standard deviation. And that's called the expected move. If you go to your brokerage trading platform, you can see that there's a table of all of the strike prices and expiration dates. And for each expiration date, you should be able to see what is the expected move. So you can use that to judge where to put your strikes. You could use any other technique you want to. You could use technical analysis, and you could say where are the regions of support and resistance and use those to set your strikes. But whatever you do, you want to have your defined expected range by your short put and your short call. Okay, so let's take a look at this Facebook strangle that I did on March 5th, 2021. You can see from the chart that Facebook is just going sideways. It's literally months of going sideways here. And what we can see is that you can kind of see an expected range here. You don't really expect it to go above or below where it's been trading for months. So we'll take a look at what we can do with this strangle. The current trading price was $258. And I wanted to do an expiration that was 4/16/21, which was 21 days out. 42 days out. So I sold a call at 305 that had a 9 delta, and I sold a put at 210 that has an 8 delta. So let's talk about what those deltas mean, literally. It's based on the pricing model, and it says that if I have a 9 delta, if the price moves by $1, I can expect 9 cents of movement on the option. If the underlying Facebook price moves for $1, I can expect a 9-cent move in the option premium. And on the bottom side, I have an 8 delta, so $1 equals 8 cents. So what that means is if the stock goes up by $1, I gain 8 cents profit on my put, and I lose 9 cents profit on my call. And as long as those deltas stay neutral, they cancel each other out, and I can get the full benefit of theta decay or premium decay over time as we approach our expiration. These strikes are both out of the money, so they're purely extrinsic value, and at expiration, they should have a value of 0, or they should at least have an extrinsic value of 0. And by managing the deltas, I can make sure that I can benefit purely from the theta. Okay, so here's what happened. I had a pop of about 83%. You know that deltas are an approximation of the chances or probability of being in the money, and you can see that the top side has about 10% chance of being in the money, and the bottom side had about 10% chance, and it worked out that the probability of profit on this was 83%. Okay, so I'm looking for the stock to stay within this trading range, stay in this triangle, and when I opened this position, I collected a credit. I sold to open, collected a credit of $287. And that gives me a break even on the top side of 308 and a break even on the bottom side of 170. Okay, so I had a buying power reduction on this of $2,877. Now that means that with my broker, I had to set aside $2,877 that had to be put in reserves so that I could cover the losses on this trade if there were any. Okay, and that's pretty heavily regulated. The broker doesn't really decide what that is, so you're not going to get an advantage on that from one broker to the next. It's regulated. Okay, so what happened was 14 days passed by, and you can see that Facebook shot up. You can see that it's gone up to 285 14 days later. So I have 28 days till expiration, and the underlying price of Facebook is a lot closer to my call strike than it is to my put strike. So I know my deltas are going to be unbalanced here. I know I probably have something like a 35 delta on my call side and a pretty low delta on my put side. So let's take a look. I want to roll up my put because it's become unbalanced. So our 210 strike is only a 2 delta. So I'm going to roll that up to 250, which is a 12 delta. So by doing that, I'm balancing it out a little bit with the top side. I'm also narrowing my region of where I can win. So I needed to stay in a little bit tighter of a trading range, but that's okay because I'm happy to have the neutral deltas and collect more premium as time passes. So I got a credit for that. I collected $148 for rolling that put up to 250. And that makes my new break even on the bottom side 245, and my new break even on the top is 309. Okay, so perfect. I want it to stay within my trading triangle. And let's take a look. Let's see what happened. A couple days go by, and now it's up to 290, and you can see that the midday price got pretty high. It was really starting to approach my strike price, and this is making me nervous because one of the biggest problems with strangles is that the market always goes up, and when the market's going up, you have to be careful to make sure that you don't breach your call strike, because once you breach your call strike, it tends to stay above it forever and just keep on going up and up and up over years. So you don't want to take any chances of having it go above your call strike and staying there forever, because that can be a losing trade. So again, we want to start to manage this, and the way we're going to manage it is we're going to sell another put. Now you might say, why not just roll up the 250? Well, I have a little region of support over here, and I really just didn't want to roll up past that region of support. And the idea is to neutralize my deltas, so I can accomplish that by getting more positive deltas by selling an additional put. So what I did was I sold one more of those. I collected a credit of $205, neutralized my deltas, and that increased my break even on the top side to 311, and my break even on the bottom side is now 246.8. Okay, so this looks good, but when I sold an extra credit, it cost me a little bit of extra buying power. So instead of 2877, my buying power reduction went up to 5400. So that's the total amount that I have on reserve with my broker for this trade. So I'm pretty happy with it. It's kind of neutral-ish, and I have a good window. I have 25 days till expiration. Let's see how it works out. So another day goes by, and it goes up to 297. And now I'm starting to get a little bit nervous because it looks like it's getting pretty close to my 305 strike. My 250 on the bottom side here is only a 5 delta, and I'm thinking that's not balanced anymore. So I need to balance my deltas by rolling up my puts. So I have 250 strikes. That's a total positive delta of 10. On the top side, I don't remember what it was, but I'm guessing it's somewhere around 40 or 45 at this point. So 10 on the bottom, 45 on the top. I want to neutralize this. So what I'm going to do here is I'm going to roll it up to a 270, which is a 14 delta. And I have 2 of them, so that's 28. So I'll have 28 on the bottom and maybe 45 on the top. It's approaching neutral. So this is a better position. I collect a credit of that for, let's see, 127. It looks like my credit, and that makes my new break even on the bottom 266, and my new break even on the top is 312. But again, I'm trying to just keep the deltas neutral, because as the stock moves $1 up or $1 down, I want to break even on my option premiums. So Here we go. We got a little window. We're trying to stay within this triangle for the next 24 days. And let's take a look and see what happens. So it shoots way down, starts to approach my 270 strike. And that made me a little bit nervous because I have two of those and I don't really want it to breach that, but it wasn't really all that close and I wasn't really all that nervous. So I waited it out. Maybe this was a little bit overbought and it had just a tiny bit of a correction. And sure enough, it shot right back up. And here we are, 15 days till expiration. And I'm sitting at a price of 301. It's just a couple bucks below my 305 strike. And my deltas are out of balance again. So what do you do when your deltas are out of balance? You roll, right? So I wanted to roll everything up and out. So what does that mean? 15 days till expiration. I'm going to roll that out to 21 days till expiration. Give myself an extra week to collect more premium. And again, I want to be in this trade as long as possible, actually, because every day that passes, I'm collecting premium. The theta decay is happening day after day after day. And if I can stay in this trade with the underlying price between my two green lines, every day is a win. So I moved it out. I get 7 more days of collecting premiums. So I took my top side strike and I moved it from 305 to 320. And I moved my bottom side from 270 to 280. So I kind of recentered my window here and I collected $20 in premium for that roll. Now you might say, oh geez, you put out an extra week and you only collected $7, or excuse me, $20. You rolled it out for 7 days and collected $20. That's not a great credit. But I already had a lot of premium left to decay and I was pretty happy with that. But what I wanted to do was give myself a safer position, a more neutral position, a more centered position. And it was worth it for me to roll it out for an extra week and only collect $20 and be better positioned in the play. So I had a new break even on the top side of 328 roughly and a new break even on the bottom side of 276 roughly. And I'm pretty happy. It's going to stay in this triangle. Everything should be great. We're going to move forward and see how the next 21 days go. Okay, so here we go. It immediately shoots up above my my target window here, shoots up to 310. And it's only $10 under my 320 strike. And I'm out of balance again. So that kind of sucks. So I want to manage this trade again. It's 16 days till expiration. Let's see what we can do. I'm going to roll everything up and out again. So I'm going to take my 16 DTE expiration date. I'm going to push it out to 23 DTE, about a week. I'm going to take my 320 strike and bump it up to 345. That'll give me some room to breathe. And I'm going to take my 280 and I'm actually going to move it down to 277.50 because widening that gap between the two strikes gives me a higher probability of winning. And again, I have 2 puts on the bottom, so it can be a little bit further away than it is on the top. And I collected a credit here of $60. And again, I don't care about the 60. The 60 is a nice little extra premium, but really it was about enabling myself to collect more theta decay over more time, more days in trade, and staying in between my green lines. So I'm better positioned with a more neutral delta. So definitely worth a roll. So a little bit of, my break even on the top side was 253. And my break even on the bottom side was 273. So I'm sitting pretty happy with this trade. I need to stay in this window and let's see how it goes. Here we go. Some days pass by and it stays right within my triangle, and I'm actually quite happy. The price moved to 304. It's very well centered and this is a great position to be in. I only have about 4 days till expiration and I'm ready to roll this out again because I want to collect more premium and have more time pass. But I took a look at the table and I noticed that earnings are coming. And I don't want to be in this trade during earnings. When a stock has earnings, unexpected things happen. It could shoot up, it could shoot down. Actually, I have no idea what it's going to do. It tends to make volatility a little bit crazy or a little bit unexpected behavior. And I don't really like to be in strangles during earnings. So I decided it was time to close this trade. So here's what we did. I bought to close. Remember, I sold to open over here for $287 and received all these credits. And now I bought to close the Strangle for $190. I did a lot of rolling and I had some fees. It added up to $14. It's not much, but it's not negligible either. So let's include that. And that leaves me with a profit of $640, right? I collected all of these premiums. I bought it back for $190, had a few fees, made a total profit of $640. Now that gives me a return on capital of 11.85%. That's $640 over my investment of $5,400. It's 11.85%. I was in the trade for a total of 52 days in trade. And if you work that out to be an annual ROI, that's 120%. Now that's not nearly as good as the one we did the other day that had 680% ROI, but 120% ROI is pretty good. That's like 5 or 10 times better than the market. So I'm happy to take that all day long. And we have a bunch of these on at any given time. This one, I'm showing you it as an example because it needed a lot of management. A lot of our other strangles don't need much of any management at all. We just collect premium and we're happy with it. And we have a higher ROI because of it. In this case, we only made a return on capital of 11.85%, but we do trades like this all the time. They almost always work out in our favor. And it's just a really good example of how to manage your deltas and why to manage your deltas. So I hope you learned a little bit about managing your strangles, and I hope you liked this video. If you did, click the like button below, and I'm going to do a management of a cash secured put on Riot coming up pretty soon. I'm in this really volatile Riot position, but I'm making a lot of money on it. So hopefully I can put together a video to show you exactly what I did and how I did it, and you can learn something. Okay, see you in the next video.